Hello, everyone. Today on the final bar, my guest is Dana Lyons joining us from Chicago. He was on the show back in January. We had a really good discussion about some risk potential and breadth indicators. We're going to talk about sentiment today in the form of volatility, what that tells us. Obviously, a lot of catalysts this week with a ton of earnings. I think about 15% of the S&P reporting earnings today, either before or after, with names like Amazon, Microsoft hitting the wire. So a lot of things to digest. Now is the time to be looking at the charts together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together. There are no shortage of catalysts right about now with the elections coming up in less than a week, with activity of the Fed and top of mind, liquidity issues with coronavirus and what that might mean, economic conditions increasing, decreasing, good economic news, but then shutdowns sort of increasing at the same time. So and earnings, so we didn't even mention that. I didn't even get to that yet. So there's so many things going on. And again, I'm often asked during an environment like this, are charts even worthwhile because it's all this other stuff that's driving things? And I will tell you, just having worked with a lot of investors in a lot of different scenarios, I would say at a time like this, when there's a lot of uncertainty, there are a lot of potential catalysts, charts are arguably more helpful than anywhere because, again, the markets are a discounting mechanism. It's all about expectations, how those expectations are changing. So looking at the charts, you're looking visually at how people are interpreting, how they're, the odds that they're attributing mentally, explicitly or implicitly to different outcomes. Like gives you basically a sense of what investors are thinking at a given moment. The price doesn't lie. That's a representation of where people are leaning, and again, now more than ever. But there are so many things to try to uncover. We're going to hit on as many charts as we can. We have some great guests. Again, my guest today, Dana Lyons. Really interested to hear his take on where things are at. Again, given this environment that we're in. Coming up next week on Tuesday is Wednesday on the 4th, Frank Capillari from Instinet coming back on the show. On Thursday, Mark Ungewitter from Charter Trust is going to be joining us again. Also, earlier today, we premiered our latest episode of The Pitch, which is a chance for 3 strategists to come in. They each have an opportunity to pitch you their 5 ideas right now. It's a really cool conversation. And this one in particular was lively and meaningful. Mark Newton from Newton Advisors, John Kosar from Asbury Research, Aaron Swenlin from Decision Point, and then Grayson Rose from StockCharts moderated that discussion. I watched it a little earlier. It was fantastic. It's a really good push and pull, give and take between the 3 of them debating what they're seeing, and some great ideas that you'll jot down watching that special. So check it out on our YouTube channel or on a replay on StockCharts TV if you missed it. Let's get to our market recap. So the S&P really up today and finished about 1.2% higher, closing around 3310. Gave back a little bit in the last hour and a half, 2 hours of trading. Most of the gains were right out of the open, and then after lunch, you sort of had the nice rally. So if we get a little bit of a give back going into the close, but enough for the S&P to finish stronger. Small caps actually led the way up almost 1.6%. Mid caps lagged a little bit, so a bit of a mixed bag there. The NASDAQ 100, the best of them all, up 1.9%. The VIX down to just below 37. In terms of other asset classes, you had bonds finishing weaker, and really most of that came out of the open. You had a sort of stocks over bonds theme for much of the day, and yields higher, with the 10-year yield around 84 basis points. On the commodity side, oil lower, gold lower, silver lower, not too much, but enough, and so that sort of entire group down pretty good. Let's look at a chart of the S&P 500, start to look at some visual themes. So, it's an interesting pattern that we saw on the chart today. Earlier, I would have called this a bullish harami pattern, which if you know your candlesticks, you know what that means. If not, what that is if you know a bullish engulfing pattern, which is a down candle, a big down day, and then you have a big up day. And the second day's open to close range engulfs the first day. So on a candle chart, you have a big down candle and a big up candle, and the second one's a little bigger. That's a very bullish signal. We did not get that, and because we opened a little bit higher. If the close is high enough on day two, you can call it a bullish harami, which is basically the second day is a long up day, but you didn't close all the way above the first day's high. We didn't quite get there. We finished about 50% of the way. So I don't know if I would call that a harami pattern, but you certainly had buying, more buyers than sellers, if you want to describe it that way, through the course of the day, finishing higher than the open, finishing above yesterday's close. So a bit of a bounce. And again, given yesterday, you normally have a reaction to that sort of move, even if the primary trend still is down. A day like today makes a ton of technical sense because you have sort of a rebound. The question is that sort of a dead cat bounce, which is the probably horrible way that we describe a big down move followed by a quick up move. It's sort of like a quick reaction, even though the primary trend is lower. Now, having said that, the way that you determine where the primary trend is looking at the highs and the lows and how they're evolving. We have now established a lower high around 35.50. This was the second week in October. Now you're starting to determine whether or not you establish a lower low, which completes this rotation from a bullish phase to a bearish phase. And I think if we break through 3,200, I think you have to start thinking about the potential for much further downside and making sure you have a proper risk assessment given that potential scenario. I don't think it's too early to be thinking about what the charts you're following would look like and what you would see that would start to tell you to get more defensive. And again, I think as long as we remain above 3,200, this primary trend still okay. But if we break down through there, I think it could be a bit of a concern. We don't look at the weekly model too often during the normal course of the week, but I wanted to highlight it today. Now, this really, I don't update this formally until Friday's close. That's when it sort of locks in. But if today was Friday, the medium-term signal is actually registering a sell signal. Again, if we finish the week around where we're at, if we would rally dramatically tomorrow, that might be negated. So this is not locked in just yet. But overall, it's starting to rotate, potentially give a sell signal this Friday. The short-term signal, which for me is just the price relative to the 5-week exponential moving average, certainly most likely looks to be turning negative. So that signal, that medium-term signal, which is really based on a traditional weekly MACD or the weekly PPO, has been positive since May, really early May. It turned positive after the market low. The last time you had a sell signal was there in mid-February, which was really just that first week after the February market top, when things really started to accelerate. That registered a sell signal. So you have some similarities to what we saw there in February. Now, again, that is not locked in yet, and it's not saying we necessarily going to repeat what we had in March, but it does tell me that the overall bias should be more negative than positive, and that the potential for meaningful upside is limited until you get some sort of return to a positive trend there. That's kind of how I use that trend following model. We've talked a lot about the breadth conditions in different scenarios. I wanted to point out, because we've talked about advancers and decliners. Today was about a 70% up day, just based purely on the prices. I tend to look at advancers and decliners as a percent of the total stocks on the NYSE and just see what I can see. We did have a 90% down day yesterday, so we've had a cluster of negative moves. What's interesting when I look at the chart now, we highlighted this in the 3 and 3 yesterday. I was noticing this morning how similar right now looks to September, to this market bottom in September. You had a couple good down days in here. You had some 80 to 90% down days there, that sort of third to fourth week in September. That ended up being the bottom. It was a bit of a capitulation, right? When you have everything going down, that could happen at the end of the move, where it's like the final puking out of all the negativity. You saw that with some huge down days near the low back in March. So again, for me, that sort of breadth read is secondary to the price. If the price remains above 3,200, I think overall the trend remains. You can argue that the primary trend is positive. If we break that, I think you have to think about the potential for downside. By the way, if you do buy into that thesis, and if you do buy into a sell-off below 3,200 means we could go materially lower, one of the basic ways to measure that is use the height of this pattern, which would be just below 3,600 down to 3,200. So back of the envelope, you're sort of down in this 2,800-ish range. It might be a little higher if you do it on percentage terms, maybe 2,900, but that puts us down below the June low and back down into this sort of May-June range, sort of in this area. That's where that's sort of measured. And that's literally taking the height of the pattern, subtracting that from the low and sort of putting it down into this range for what it's worth. Let's look at some of the other themes. So on a sector basis, energy actually the best of the 11 sectors with the XLE up 3%, a little bit above that. Communication services second with 2.5% positive. And again, there's plenty of stocks reporting in some of these sectors, so worth paying attention to what that means, especially after the close here. On the downside, healthcare was the one of the 11 that was down pretty meaningfully, down 0.8%. Consumer staples essentially flat, and everything else sort of net positive from there. In terms of industry groups, you had a couple groups up pretty big with media agencies within communication services, number one. You had some other ones, integrated oils up 3.7%. Again, that's interesting. What concerns me about those charts, it's still so early on. So, nice to see the bounce, but overall, as a trend follower, I'm much more interested in charts that are actually showing strength over time and showing accumulation. This still is not showing. This is showing more of a bounce off of a pretty weak level, new low in that group. A little later in the show, we're going to do a segment, It's All Relative, where we're focused on some of the trends that are more positive and how they've evolved. So I think we'll leave it for there. I did want to point out in airlines, you actually have an interesting pattern here. You could call this a bullish engulfing pattern coming off of the lows here. It's bouncing off of that 140 level, which is exactly where you found support back here in late September. So, while the S&P is sort of still above there, some of these groups are actually right at that support range, right at that, within the range of that low day. And so, potentially seeing a bit of a bounce here. Again, overall with airlines, it's not the best chart from a technical perspective, and I think you still have a lot to gain before you could feel encouraged about this from again, from a trend perspective. You have to get back above the 200-day and back above 160 for this group. This is the Dow Airlines group that we're looking at here. So you could look at like the Jets ETF or some of the larger stocks within there. You have some names moving pretty good that are causing that to fluctuate. On the downside, renewable energy equipment, this was the number one group yesterday, and that was the solar stocks are in that group for us. That's First Solo and others that, huge update yesterday, kind of coming back to earth a little bit, but still worth paying attention to see what happens there. And then finally, I just want to highlight that the China ETFs, we've highlighted those in recent days, recent weeks, really in a position of strength, and talk about the strength of emerging markets versus developed markets. This is certainly helping that story with China, pretty decent weighting, pushing to the upside. We need to take a quick commercial break. Back with my guest, Dana Lyons. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, whatever else we can bring to bear. As a reminder, we'd love to hear from you. We'll do another mailbag segment at the end of this week, and we'd love to answer one of your questions. 3 ways you can get your questions to us. Number one is via email, thefinalbar@stockcharts.com. Second is via Twitter, @FinalBarSCTV. And the third one is via YouTube. Just put a comment below the video you're watching. We'll capture all those questions and to get to as many as we can in our next mailbag segment in Friday's show. I want to welcome on my guest back to the show, Dana Lyons. Dana is from J. Lyons Fund Management in Chicago and also the editor of the Lyons Share Report. Dana, it's awesome to have you back. We had you on the show in January. I was looking back at your appearance there, and you had some really thoughtful takes on the market feeling overextended. A lot of what you were talking about really played out with the weakness in February to March. So welcome back to the show.
Thanks, Dave. It's always good to be on. I think the last 2 times I was on, we were on the verge of an imminent market top. So I hate to be like Dr. Doom here.
We're going to start looking for your appearances as a signal potentially here. We'll see
exactly
what happens next. But so your first chart, appreciate you sending a couple charts ahead of time. First one's looking really at the growth theme. What are you seeing here? And obviously a lot of things happening. Talk us through this chart.
Sure. Well, I hate for the bears out there. I hate to be the bearer of good news here. I might not be Dr. Doomsday today. As far as these charts go, so late August, the rally, we noticed the rally getting starting to get pretty thin. Only a couple of the groups were participating, so we got a little defensive. We got that reset in September, and our main risk model, which depends a lot on breadth, was wavering. Funny thing happened in early October. We saw a rejuvenation in the market internals and breadth and the amount of participation in the rally, including two key areas, small cap growth and mid cap growth. So here we're looking at the Russell 2000 growth index and the S&P mid cap pure growth index. And after teetering in September, they really took off in October and actually broke out to new all-time highs above highs that we've seen a couple times over the last couple of years. So that was kind of symbolic of a breadth, a kind of a rejuvenation in breadth and participation that was extremely healthy, I think, in early October. Now, the latter half of October, the last couple of weeks, we're seeing the sell-off here, and people are getting a little bit fearful. But I think I think they may lose sight of the fact that perhaps these indices, these broad indices, are just pulling back and are about to test those breakout levels to all-time highs, which is for our money is basically the best trade entry point you can find.
And it's interesting. It lines up really well, Dana, with the, seasonally November and December tend to be pretty good through year ends. That actually could line up pretty well with that. You're,
Sure.
speaking, rotate very nicely to the fear gauge of looking at volatility in the form of the VIX. How does this relate to what you're seeing?
Sure. So a couple weeks ago, we saw the VIX. The VIX has stayed pretty elevated throughout the year, which has been a bit of a concern. We saw it even remain even more buoyant in early October, despite the rally in stocks. So we took a look at the VIX instruments across the curve. So not just the 1 month VIX, which is the VIX, which everyone is familiar with, that covers volatility expectations over the next month or 21 market days. You also have the 9-day VIX, which is the short-term VXST, which covers volatility expectations over the next 9 days. So looking at the recent bump up in the VIX a couple weeks ago, we noticed we didn't see the same bump up in the short-term VIX. In fact, the spread between the two got to I think the second largest margin in the history of the contracts, which suggested to us that, okay, maybe the VIX is just looking at a specific event risk 1 month out, which was, of course, the election, as opposed to maybe, an overall broad market concern. So lo and behold, when we got a couple days ago, we hit that 9-day threshold. So a couple days ago, we entered the period where the election day was within that 9-day short-term volatility index. And lo and behold, we saw that short-term VIX spike up. And now the VIX has also risen over the last couple of days, but not nearly as much as the short-term VIX. So the message here to us is that the bid in the volatility markets may be more due just to the election, just to the uncertainty surrounding the election, rather than some broad overall market concern. And while we have found that sometimes the volatility market is the smart market, we do see spikes up lead to some volatility in the near term. In the longer term, it doesn't typically hold water. So in this case, our thought is we're leaning towards this being more of a sign of uncertainty and fear about the election rather than a broader market concern.
Dana, this is a refreshing bit of market optimism I'm picking up from you, and I appreciate it because we've had a lot of, thinking about potential downside. This is a refreshing, look at potential support here, especially on those growth indexes and with the look at volatility. Dana Lyons from Lyons, J Lyons Fund Management and the Lyons Share Report. Thanks so much for coming back on.
Always a pleasure, Dave. Thanks.
This is Dana Lyons joining us from Chicago, and I love, and again, it's fantastic to think about that potential parity or that polarity, I don't know what you call it, where basically the resistance from earlier in the year and previous years, it sort of lines back down. And again, I think that's certainly a way you could even interpret a chart of the S&P 500. That pullback to 3,200 could end up being the ultimate entry point, riding the S&P to a new run higher. Again, I think a lot of questions potentially are answered over the coming weeks as we think about elections. We start to digest how that is evolved, how that actually plays out. But interesting to see that take. I love the charts from Dana. Our next segment is called It's All Relative. The goal here is to focus on relative strength. And as I've told you, especially when the markets start to get uncertain, there are always stocks outperforming, there are always stocks underperforming. And I think at any time, it's important to pay attention to that relative strength line, but especially at a time like now. When I'm talking about relative strength, and again, when we're talking about relative strength in this context, it is not the RSI. And I just want to, very quickly, we're looking at a chart of Amazon, which is just reporting here after the close. But we have price here. We have the RSI, which is essentially a measure of internal strength. It's looking at how strong the price is moving now relative to how it usually moves, and that's why it was called relative strength index. It's not relative to any other asset class, any other price or anything. The relative strength line or relative performance is the line here, which is a ratio of Amazon versus the SPY, right? And so it's common to do this relative to the industry, relative to a sector, relative to the benchmark. And that's what we're talking about when we talk about relative strength. It's really focusing on the ability of a stock to outperform other names that you could be looking at. The reason why this is so important is when everything's going up, like you saw from March to July, for example, or March to June really was the bulk of that move. A stock like Amazon outperforming tells you that it's going up stronger than other things. So owning a name like that allows you to outperform the rest of things. And when the market overall kind of chopped around in June, you can see that this continued on and accelerated into the July high. So we've looked at that in different places. In particular, we talk about consumer discretionary, and I think in yesterday's show or the day before, managing to continue to outperform even when everything was pulling back a little bit. So that's kind of the general theme of what we're looking at. What I wanted to do was just run a scan. This is a common scan I've used. I actually did a presentation yesterday morning for the Money Show and did it on momentum models and used our scooter rankings as an example of that. It's the StockCharts technical rating. And so this is a scan that I run just to look for strong trends where the markets pull back a little bit. Strong charts, but short term it's pulled back a bit. And again, if things are going to continue to get better, that means you're getting into a strong uptrend, but you're buying in on a weaker point. So the way that I created this using the scanning engine, I just said here I'm actually looking at ETF. So this is within our normal ETF group. And if you don't know that one, you can say group is ETF NOUI. You'll find that on the drop down on our scanning engine if you go to build it. But basically says I only want to restrict it to ETFs. I have a liquidity measure, just looking for a volume restriction. Scooter ranking over 90, which means it's in the top 10% of ETFs. And then an RSI, a 14-day RSI below 50. If you think about it, what that means is the scooter ranking being in the top 10% means it's one of the strongest longer-term trends out there. The fact that the short-term, the RSI has come off means it's pulled back a little bit. And that's how I try to sort of put that in. I often treat the scanning engine not as a group that you finish with. This gives you the starting point. The next thing you want to do is put these charts into play and start looking and seeing what you can see there. So some interesting things come off of this. Number one, I've sorted this by scooter ranking. So I basically have the strongest trends at the top. The couple that appear at the very top of this list are the clean energy ETFs. Now, these are ones that include a lot of the solar names like First Solar, what else? Enphase, Solar Edge are all sort of in these kind of ETFs. Look at one of these. ICLN is just an example. And again, when we're talking about relative strength, we're looking at this line at the bottom and looking for long-term appreciation. So what's interesting, if you look at the clean energy ETFs, they're all kind of in a similar pattern, a little different depending on the construction of them. So obviously, do your due diligence on what's included. But overall, I see if you think that market theme is going to continue, if you think the markets are going to recover and continue higher, arguably a chart like this is sort of the sweet spot. You call this a fat pitch chart, which is a long-term uptrend. Long-term, the trend is positive. Long-term, we have outperformance. It's above 2 upward sloping moving averages. That's always just a general check on a long-term uptrend, but it's pulled back a little bit. So the last couple of weeks have been more weaker, but it's not broken down through any key support. It's not broken down through the previous swing lows. It's not broken down through the 50-day. And so between now and the 50-day, it's actually not a bad, risk reward if you assume you have potential to return back to the previous high. So it could be at a buyable point, and also the fact that the RSI is really just still right at 50, coming off from an extreme overbought condition. So the momentum has been pretty strong for a while, potentially pulling back to a buyable point. Other things that are in here: the Renaissance IPO ETF. And again, we don't have time to go through the construction, a lot of these, what all are included. So as always, when you're looking at something like an ETF, it's important to pay attention to the construction of it, what's included, expenses, all of that. So, please make sure you would go through any of those motions. But it's interesting from a technical perspective, this IPO ETF, again, long-term uptrend, the relative strength has been fantastic. So it's outperformed the S&P over the last 12 months by over 60% on a relative basis. You can see how it's really accelerated out of the March lows. And while, the S&P itself has sort of chopped around at times, this looks like just a pretty consistent uptrend. Higher highs, higher lows. You really haven't had a lower low since March, which is pretty impressive. Again, above upward sloping moving averages, remaining above its 50-day moving average. As long as that remains in an uptrend, as long as we remain above there, pretty interesting. Now, some other things get a little more interesting. You have things like the XHB. This is one of the home builder ETFs. Now, the XHB, if I remember right, is one that also includes things like Home Depot and Lowe's, and sort of, it's not a pure home builders play. It's like home builders and home retail and other sort of things. This one's a little different, so you can see how this chart relates to the other ones. This has broken down a bit in terms of below its 50-day moving average. That on its own may not be the end of the world. I think remaining above $50, which would be at the low from coming off of the September peak or the August peak in this case, I think that's a really important one. As long as it remains above it, I think that's pretty good. But I'd much rather be looking for things that pull back and remain in a pretty strong trend. The long-term relative strength remains positive. In the short term, it's come back a little bit, so it's down about 4 or 5% off of the highs. But overall, the trend has remained pretty strong. So again, as long as it remains above some of those swing highs, I think that would be pretty helpful. As a reminder, in yesterday's show, we talked about the mindful 6 and 6 key stocks to pay attention to support, some similarities I'm seeing with a chart like the XHB. So I think those are key lows to key in on to make sure that we remain above them. That is our segment. It's all relative. Again, it's starting with just a basic scan. We only went through a couple examples, but I'd encourage you to run scans like this and just see what pops up. Again, it's not telling you to blindly do anything, but review those charts and see what opportunities you can uncover. At this point, we need to wrap the show and go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is this market trend model. We usually refer to this every Friday, sometimes on Monday as well. It's part of our normal weekly review, paying attention to what's happening. The reason why we're highlighting it today is because if the week ended today, the medium-term model would turn on a sell signal. The last sell signal was at February. It's been positive since May, so it turning negative would be the first time in this run off of the March lows, really. So I think it's important to pay attention to. The long-term model still remains very positive. That would not trigger until you've had a much deeper sell-off. But this medium-term model tends to be sort of the key part of my timing approach, thinking about the trend. So I think that's an important one to watch. The second one, in terms of breadth, one of the ways we measure breadth is looking at cumulative advanced decline lines. I think one of the issues that we saw here recently was the S&P advanced decline line went to new highs in October. The mid-cap advanced decline line went to new highs in October. You did not see that happen from the NYSE advanced decline line, which remained at its August peak. The same thing with the small cap advanced decline line, never broke above that. The small cap one in particular, again, has retested it and now rolled over. This isn't updated through today's close just yet, so it may bounce a little bit given the bounce we saw in stocks. But overall, the fact that you haven't had that confirmation from these breadth lines tells me that at this point, the breadth tells you the upside is limited. Again, that can change if you start to see these rotate higher, break to new swing highs for the advanced, the NYSE and the small cap lines. I think that would confirm, potential for further upside. But at this point, it tells me to expect more limited than not. Finally, we're going to start with finish with an individual name, Amgen. Again, I'm not a big fan of buying falling knives. I'm not a big fan of buying lows. I'd much rather buy once something has turned higher, but I'm always looking for what I call a bottom fishing candidate, with something testing support, bouncing off of lows with Amgen. It just got to its 61.8% retracement level and is now closed higher today. This is a similar range to what you saw with the low in June. So we're above that last Fibonacci line. That would be the downside risk, but with potential for upside. The RSI just coming out of that oversold region potentially. So I'll be looking for that to see if there's a short-term bounce. That's our show for today. I want to thank Dana Lyons, editor of the Lyons Share Report, joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.